Welcome back to Focus on the Future. Today we really are going to look to the future that awaits many of you, that being attending a university or college or pursuing education beyond just your high school diploma. Most of these pursuits will require fees, tuition, or both. With the cost of post-secondary education continuing to rise, many students face an interesting dilemma. How will you pay for your continuing education? There are many alternatives, of course, but one answer might be student loans. Before you make that decision, however, there are some things you should know. Our guest today is an expert in student loans. Sarah Elliott works for a major community college and will give us the information you'll need to make good financial decisions for your future. Welcome to Focus on the Future, Sarah.
Great.
Good to see you.
Good to see you too, Skip.
Let's start out with just the basic question. What in the world, if I'm looking at going to college and perhaps I'm a junior in high school at this point, a senior, what's the first step?
The first step is going to be deciding on the college that you want to attend.
Okay.
And you're probably going to want to look at the costs at that school, what type of financial aid you can receive there. Sometimes a school whose tuition is higher might offer more scholarships, and that might be a better choice. Other times a school might be closer to your hometown and you can live at home or save on travel costs. And it's important, if loans do become necessary, to figure out what you're going to be repaying and look at what type of a job you can have after you finish school, and think about it not just that first year of college, but long term, how long it'll take to finish and what you will be doing afterwards.
Wow, you've just boggled my mind.
Yes.
I mean, there's so much there that you got to do to prepare
Right.
for. Now, there's this form that has to be filled out too, right?
Yes.
What's that called?
The FAFSA, which stands for Free Application for Federal Student Aid.
Free Application for Federal Student Aid. Where do I find that?
It can be completed online at fafsa.ed.gov.
And we'll show that on the screen here, I'm sure, in just a second. But say it one more time.
FAFSA, fafsa.ed.gov.
Okay, and that's free? I don't have to pay any money to anybody to fill that form out?
No, you don't. And if you do have to pay anything, it's probably a scam.
Really?
Yes.
Is there any fee for filing or anything like that?
Nope, it's absolutely free. That's
All
the
right,
first
well, what does that
word.
form do for me?
That form, you decide what schools you want to send it to,
Okay.
and from there the school can determine what you might be eligible for. And it's used for grants, loans, scholarships, and work study.
All right, now once that I've filled this form out, does that also work for scholarships and grants and student aid and work study programs and all of that?
Yes. Now, for some scholarships, it may be required that you do additional applications where you give information about your grades or letter of recommendation or why you might qualify for that scholarship. And then certainly with loans, there's an additional process. As you're agreeing to repay this loan, you'd have to fill out master promissory note and do loan entrance counseling, so
Okay.
you understand
All right.
the ins and outs
So
of it.
once I've filled this form out, I've gone online, I found that I got it done. Do my parents have to sign it as well?
Yes, and your parents will have to provide income information as well. Now that's if you're under the age of 24.
Okay.
And that income information for both you as the student and your parent is used to determine what you would be able to provide towards your college costs out of your own pocket or your family's.
I assume there's some kind of formula that's used to calculate that?
Yes, there is.
I gotcha. So there's no absolute dead solid lock that I'm going to qualify for a scholarship or a grant based on the fact that I filled out this form?
No, for the most part, the grants are going to be income-based, so focusing on families that come from lower background or lower incomes, and the scholarships are usually merit-based and usually require some additional paperwork.
What if I become emancipated from my parents at age 18? Does that is their income still a factor in that decision?
There are some exceptions for students under the age of 24 who have some special circumstances, and emancipation is one of them, and then they wouldn't have to use parent information.
Okay. Now, assuming that I don't qualify for a grant or a scholarship, I mean, the majority of the time, most institutions will offer some kind of financial aid to me in the form of a scholarship, but say I don't. So I'm going to rely only on a student loan. As an entering freshman, what's the maximum I can borrow?
For the year as an entering freshman that has to report parent information, it would be $5,500 of the federal Stafford loan.
What is a federal Stafford loan?
That's a loan that's through the government. There's two types, a subsidized and an unsubsidized. The interest rates are different for the two types, but basically they're kind of the basis of the student loan program, and they're through the federal government.
Okay, $5,500. That seems like an awful little amount, because most tuitions I look at, especially for private institutions, my gosh, you're talking about a lot more money than that.
Right.
Now this is for the whole year, it's not per semester. Okay, now, and the next year as a sophomore, what can I borrow from that?
It could go up to like $6,500.
Could. What's the factor that determines that?
Completing a year's worth of college level classes.
Will I have to fill out another FAFSA form that year as well?
You will, because it is an annual application.
Oh, it is, so it's not something I can just do once and forget about.
Nope, you'll have to do it every year that you attend
And
school.
my parents' income is always a factor.
Yes.
So probably your advice would be tell your parents to quit their jobs and no.
No, not at all. That opens up a whole nother set of issues.
Yeah, it seems to me that it would. Well, now, let's assume that I choose a college that the tuition is higher than $5,500 a year. Are there other options open to me if I can't finance it myself?
Yes, there are some additional loan options. Now, before we get into those loan options, it's also helpful to add that you may choose to maybe work during the summer to help finance your college education.
What a novel concept that is.
Right. Maybe cut back on expenses, live at home.
Another novel concept,
yes.
yeah.
Or instead of living in an apartment on your own, maybe share a room in a house with some roommates.
Right.
Maybe pay attention to where you're eating, how much you're spending to eat, the type of car you're driving, and what those expenses are, and maybe choose something that has lower expenses, all to make college more affordable. But if you still need more funding than the student loans and you've cut back where you can, there are both loans that parents can take out for the undergraduate students, and that's referred to as a PLUS loan.
Okay.
A parent loan for undergraduate students is what the acronym actually means.
Okay.
And then also private loans that could also be referred to as alternative loans, and those are secured through an outside lender. Usually something happens with the school where they determine how much you're eligible for those private loans. But those are both other ways to finance
But
your
I would have an
education.
option also to go to a private institution, a banking institution, take out a loan for my education, and the school would have no influence on that whatsoever. It's a
Yes.
private transaction between me and the bank.
There are some loans that way, yes.
Sure, and I can spend that money wherever I want to.
Right.
Yeah, I can go on spring break if I want to. Yeah, I can take my
Yep.
girlfriend out for dinner.
Yep.
How smart would that be?
Not so smart, because you'll pay for it later on.
Yeah, there is a payback, is there not? Let's talk about this PLUS loan a little bit, because
Okay.
I'm a little bit confused on that. As a student, my parents would take out this loan. They're responsible for paying it back, or am I?
They are responsible for paying it back.
Okay.
There is a credit check done, and the parent wouldn't be able to have adverse credit and be eligible for a PLUS loan. The interest rate on the PLUS loan is 7.9%. It starts accruing from the day the loan is dispersed, and there is generally a standard 60-day period before the loan has to be repaid, but parents could also apply for a deferment so they wouldn't have to start repaying until the student stops attending school.
Okay, but the interest accrues from day one on that loan.
Yes.
And people need to understand that is a big deal.
Yes.
Because when you're capitalizing interest, that makes it's like compound interest on your savings account, that we all love getting that, but paying it is a totally different situation, correct?
Right.
So you need to be very careful, it seems to me, in taking out a loan like that, especially obligating your parents that way, and then deferring the interest and capitalizing it. My gosh, that could be a big number by the time you graduate.
Yes, and with any loan, you have to factor that you'll probably be going to school for 5 years, so you multiply the amount that you borrow by 4 or 5 years, depending on what your plan is to finish your degree.
Right.
And for parents, they're also probably at some point looking at retirement or other issues that their money needs to go towards.
Sure,
so that's something
sure.
as a family would need to be discussed and thought about.
Well, that's a personal decision, and it's going to depend on your financial circumstances, the financial circumstances of your parents. There's a lot
Yes.
of variables here.
Yes.
On the Stafford loan, that's a government loan.
Yes.
What are the current interest rates? Did you mention that? If you did, I missed it.
I didn't. The subsidized loan, which is subsidized means the government is paying the interest while the student is in school.
Gotcha.
So if you're going to take out a loan, what you borrow when you take out the loan is the same amount that you'll have to repay. Now, once you go into repayment, the interest will start accruing. Right now, for the 2011-12 school year, the interest rate is 3.4% on that loan.
Wow, that's terrific.
Yes.
So let me understand this. When I take that loan out, the interest rate, it's locked in at that rate, but there's no interest accruing. So it's an interest-free loan, basically, until such time as I graduate.
Right.
And then how long do I have before that loan payment kicks in after I graduate?
6 months
6
after you
months.
graduate or stop attending school.
Okay, so the thought is that I graduate, I have 6 months to get gainful employment, then I begin paying back the student loan.
Yes, and there's another type of Stafford loan, an unsubsidized Stafford loan, and that would be more for families who don't qualify for need-based aid. There's some requirements to qualify for that subsidized loan.
Gotcha.
With the unsubsidized, the interest rate is 6.8%.
Uh-huh.
Interest does accrue while you're in school, but the repayment doesn't have to start until 6 months after you're done with school, although you could choose to pay the interest as you go, which could be one way to kind of help set yourself up for a more successful future if you're trying to take care of that interest.
That would probably make sense. Now, interest rates on private student loans, they could be all over the board, right?
Yes. For a long time, the interest rate was variable, which means you would sign up for a loan, they'd give you one interest rate. The starting interest rate for one that I looked up today was 3.5%.
Which is reasonable.
It is reasonable,
yeah, you
but
bet.
it's also variable. It can go up to 9.99%. And all of a sudden, if you are planning on just repaying at the 3.5% interest rate, your loan debt's going to increase significantly if the interest rate goes up to that 9.9.
Well, let's take a look at a comparison, if you don't mind, in terms of two students, maybe
Sure.
student A, student B, and talk about a student that has done all the right things that we've already talked about, and perhaps student B who doesn't.
Okay, great. So let's say student A is going to be our student who has planned for school. The student applied early, applied for scholarships, and worked extra jobs in the summer or during breaks as time allowed. The student finished in 4 years and just really focused on their academic plan, took the classes that they needed to finish, and they took out $20,000 in loans, so about $5,000 a year.
Right. Now, let me ask you just a clarifying question. As a freshman, I know what that limit is. Sophomore, you say, can go a little higher. Is there higher limits also for junior and senior year of college?
Yes, that would go up to $7,500
So
for
this
dependent
student didn't
students.
take advantage of that option, but borrowed an average of $5,000 a
Right,
year. Gotcha.
right.
Okay.
And so when she goes into repayment, she'll be paying $230 a month for 10 years. It comes out to about $2,760 with a total repayment of $27,620.
So she's paid about $7,000 worth of interest over that 10-year period.
Yes.
Now, could she extend that period if she weren't able to make the $200 and some odd a month payment? Could she get a longer period to pay back?
There are options with that with the federal loans.
Uh-huh.
Sometimes there's a minimum amount that has to be borrowed to be eligible for an extended amount.
There are some other options that she could choose that would get that loan perhaps forgiven or shortened, like perhaps if she teaches in a rural area or becomes a physician and treats patients in a rural area. I understand that there's some kind of options there, and maybe even military service qualifies for that.
Right, and if you're thinking about doing those, you'd certainly want to read the fine print. Studentloans.gov is a good site. It's through the federal government. It talks about those repayment options. Sometimes you'll have to work for so many years and be making payments during that time and keep your loan in good standing to qualify for any type of a forgiveness.
Studentloans.gov.
Yes.
Well, it sounds to me like student A made some very good decisions, had a good plan going in, made it work, because a $200 a month payment is something that I think is manageable for most everybody coming out of school and getting a reasonably decent job.
Right, and we're probably looking at maybe making on average or on the low side $30,000 a year for a recent graduate with a bachelor's degree.
So that's affordable. I think that makes sense.
Right.
Let's talk about student B.
Okay, so student B didn't know what they wanted to do as a student. They didn't know what they wanted to study and had to make up hours because the student didn't pass everything. You could say that he lived like a king and treated his girlfriend to nice dinners, big name concerts, rarely worked, went on spring break vacations that were tons of fun but financed with student loans, and it took him 6 years to finish. Let's say he owes $37,000 in federal loans. He took out the maximum that he could.
Right.
$60,000 in private loans. And we can also say that he took out $20,000 in plus loans, and then his parents said, "You're not passing, we're out of the loop. We'll co-sign for you for these alternative loans or private loans because they look at the credit, but it's not going to be in our name."
This guy's in big trouble.
He is.
I don't even want to know what his payment is, but I'm going to ask. What is it?
Right. Well, he's not repaying on the plus loan, so he's really just paying on the
No, Mom and Dad are stuck with that deal.
Yes. He's paying on the $87,000 between the federal loans and the private loans. For the Stafford loans, he'll pay $425 a month, and the private loan, and that would be to repay it in 10 years.
That's to the government, $425.
Yes.
Okay.
Every month, 10 years. And for the private loans, it's $608 a month. But he'd be doing that for
15 years, isn't it? Isn't that the norm?
15 years,
Yeah,
yes,
yeah.
15 years. And combined, that's $1,000 a month or $12,000 a year. And if you're making $30,000, as we had just talked about, that's a lot of your income going out towards loans. It may be safe to say, ironically, that he had more to live off of when he was in college financing his living expenses with loans than he does after he's done with college working.
Yeah, you're absolutely right. His lifestyle is going to go abruptly down the toilet.
Right, and he's paying just about the same amount that he took out in loans and interest.
Amazing. That's that's a crazy way of looking at it. But you know what? There's a lot of people in that boat. There has to be, because I noticed that the default rate on student loans is in the thousands of people that are unable to pay their student loan.
Right.
And we do have economic cycles, and sometimes there's good times and sometimes there's times like this.
Right.
And it's awful tough to pay back that student loan right now. Let's talk about default for just a second.
Okay.
What happens if I do default on my student loan?
If you do default, it will affect your credit score. You won't be able to get financial aid in the future until you clear up the default. And then if it's federal loans, they can put a lien on you and garnish your wages and or your tax refunds until that money is returned.
Yeah, I heard a nightmare story not too long ago where they actually came to someone's home and arrested them. Mm-hmm. That's a nightmare that nobody wants to have.
Right.
One last question.
Okay.
Let's talk about graduate school a little bit. I graduated college, I want to go on to school. Are there student loans available for that?
Yes, there are.
Okay.
And kind of the same applies. You can get the Stafford loans, you can get private loans. Your limits are going to be a little bit higher for each year because generally graduate school is a little bit more expensive.
True indeed.
And then some of your previous loans that you took out for undergraduate, you might be able to defer payments on those. Now, some types interest will still be accruing, so you want to pay attention.
I have a feeling the private student loans, the interest is accruing, and I got to pay it back.
Right.
Yeah.
Right.
But with the Stafford loans, I may be able to extend that period until I finally do graduate with whatever postgraduate degree that I have.
Right, but an unsubsidized Stafford loan, there would still be interest accruing.
The interest is going to accrue from day one on the graduate side?
For any unsubsidized Stafford loan, whether you're doing undergraduate or graduate studies.
Understand. Mention the two websites again that you mentioned. First,
Sure.
the FAFSA side, and then the student government side.
Right. The first one, to complete the financial aid application, the FAFSA, it's fafsa.ed.gov.
Okay, and the second one?
Studentloans.gov.
Studentloans.gov. Sarah, thank you so much for being with us. This
You're
was
welcome.
extremely informative.
Yes, it was. Thank you.
Thank you. Wow, Em, that was a great interview. I thought it was superb. What'd you think? What'd you get from it?
There's a lot of information when it comes to understanding student loans, a lot of interesting terms that you need to be aware of what they mean and what the long-term financial aspects are of taking out these student loans for college.
No question about it. And you've got to get some expert advice. Yes,
You do.
You start with your school counselors. They can help. But you need to go to a person like Sarah that has the expertise and
Qualified.
can lead you. Yeah, exactly, and lead you on the right plan.
And make a plan. This isn't something that you think, oh, hey, I'll take out a student loan. That sounds like a good idea. I need it for parties or spring break. It's for school purposes only. And be aware you have to pay it back plus interest.
Well, Em, you're not that far out of school, and
I
I'm sure
know.
that you had friends that did that very thing, that talked
did.
about, what the heck, we can go on spring break, just get a student loan.
I didn't go the student loan route, and I'm very thankful that I didn't, because you have to pay it back. I exploited the free resources, which were grants and scholarships, stuff that I don't have to pay back, and I lived at home. That was my choice.
Yeah, and when you look at this comparison between student A and student B, it only makes sense that you want to be student A, because otherwise you're burdened for an awfully long time. That $1,000 a month payment student B is paying, that's a mortgage payment.
That's a lot of money, and that's a long period of time you got to pay back.
Yeah, no doubt about it. Well, what's next?
Up next, we have Budget Busters, and then followed by the Stock Market Corner. Stay with us.
See you next week.
Hi, welcome back. Before we go any further with our budget tips, we need to discuss something that I think should be very basic. However, judging by the amount of overdraft fees collected by banks across the U.S. every month, it's not as basic as perhaps it should be. I'm talking about balancing your checking account. Now, keeping track of how much money you have in your account is actually pretty easy, believe it or not. All you have to do is add up your deposits for the month, subtract your charges from the account and any bank fees that may incur, and you get your balance. That's it. This is something that you must do every single month. It's really easy and it will save you money. It's a big deal. Overdraft fees can be a real budget buster. Most banks charge between $25 and $40 per overdraft. So if you make a mistake and overdraw your account, the bank will usually pay the charges, but then will charge you a fee for each item that they pay over your actual balance. This amount can add up to a lot of money in a very short amount of time. Here's an example. Let's put the numbers to it. 5 items could cost you up to $200, not to mention interest on the overdrawn amount or merchant charges for items that weren't paid by your bank. Most of us do our banking online, or we use our smartphones and check our balance and access the account that way. We use ATM machines or on a regular basis, and rarely, if ever, actually walk into the bank or a credit union. We tend to trust the financial institution to keep track of our checking account balance for us. However, it's not their job, and we get into big trouble with those overdrafts. Remember, it's your responsibility to keep track of your checking account balance. Some debit card and ATM transactions may take up to 10 days to post to your account, so the balance the bank or credit union shows that you think that you have is not really actual and it's not really correct. So what's the solution? What can I do? All you have to do is carry a check register. You can get a free one from your bank, and now they make really tiny ones that you can stick into your wallet. So use that register to write down every charge and every deposit to your account, and when you made them. Then at the end of the month, you simply reconcile the account by comparing those two amounts. You can balance your checking account and avoid those overdraft fees. Keep the money in your pocket, not in the bank's. See you soon. Hi, welcome back to the Stock Market Corner. I'm Emily New.
And I'm Tom Crow.
Well, we're out of September into October, so what's going on with the markets?
Markets had a little bit better week. We're finishing off this week in response to a jobs report, but it's nice to see September gone and that it was a bad month. I think we ended up down about 7% on the S&P 500. The worst part of that, looking back historically, is the S&P's down almost 23% since January 1st of 2000.
That doesn't sound good to me.
That's a lot of years to be sitting below break even.
Ooh, yeah.
So that is advice towards just buy and hold and forget about it forever. Don't do that.
Don't do that. You got to keep reviewing,
You
right?
can't just sit in one mutual fund forever, because if you do, you could be looking at 12 years down the road being down 22% and wondering where that 13% every year out of the market's going to come into your portfolio, because it's
I don't want to
not.
think about that. That's a scary number, Tom.
That's right.
Well, I'm glad September's over, and you said historically it's bad news,
Yep.
so we're on to October, and this week was pretty good though, right?
The market was pretty happy. We had several triple-digit days up in a row, which is always good.
Mm-hmm.
It would be nice, though. We talked a couple times ago about some of the volatility.
Right.
Those kind of 1% and 2% days are still pretty volatile. Mm-hmm. So it would be nice to see a little bit of restraint and maybe get down to it's nice to see, 2, 3, 4, 5/10% in a day. And to see a lot of those in a row is a nice, organized, steady growth market where somebody who's trading or buying and holding can make some money. Whereas if you're trying to do anything in this market by using stop losses or protecting positions, you're just going to get whipsawed out every time.
That
You're going
sounds
to buy
too
something.
complicated.
You're going to buy something. It's going to go up, and you're going to feel like a genius for a couple of days, and then the next day you're just slammed down and you're out and you've lost. And that's what we've been seeing this last maybe 2 months in the market has been pretty volatile.
So is it that we're into October and out of September that we're easing out, or is stuff kind of mellowing out in Europe, or what can you attribute this to?
Well, a lot of things. We always kind of take a little bit of a breather in October because you've got the third quarter earnings reports are going to start coming in.
Oh, okay.
So right now we'll start seeing, I guess Alcoa will kick things off here. We'll start to see
What's
corporate
Alcoa,
earnings.
real quick? I'm sorry.
Aluminum company.
Oh,
sorry.
Okay, aluminum.
They will start reporting earnings, and they always kick off earnings season, and then you'll have most of the companies in the S&P are on the calendar quarter, so a lot of companies are going to report earnings. What it looks like from preliminary guidance is that most of them are going to be pretty strong. So we should see some good numbers and a little bit of a return, maybe to some growth in the corporate industry. What we had this morning with the jobs number was 103,000 jobs created, which is not a great number. We really need to be at 150 plus. In fact, from a point of perspective, we could be at 230,000 jobs created average per month for the next 3 years. And that would get our unemployment rate from 9.2 to 7%.
Oh, wow.
So this is a long, steep hill to be climbing, and
We need more jobs.
We're doing it just so incrementally and in such little steps. 150,000 jobs a month is what it takes just to keep up with population growth and with people coming out of college or entering the workforce. So we're still kind of below break even on that at 103,000. And when you consider that 45,000 of those were the Verizon workers that were striking last month coming back to work,
I heard about that.
we're still pretty anemic in terms of job growth, and it could be better.
Well, quick question before we revert out of the jobs sector here. What about, are people getting into the markets a little bit more in October because those earnings reports are coming out? Are they feeling a little bit more confident about, buying and maybe selling and actively trading?
I still think this is a trader's market, and that's evidenced by the volatility we're seeing. Historically, the period from October through April is when you want to most be in the market. So we will start seeing maybe some longer term investors coming back in, some of that money coming off the sidelines, some of the institutional investors and the folks that run the mutual funds, besides the hedge funds. We'll start to see some of those long-term buy and hold or longer term buy and hold folks back in.
Well, I know that you're talking about the job statistics, and another statistic that a lot of us pay attention to is the housing market.
Right.
Is there a correlation between those folks that are not working and the housing market? And
Well, there almost has to be, doesn't there?
I would think so.
If you don't have a job,
probably not buying
you're probably
a house.
not buying a house. You're probably not able to refinance. These are some of the folks that are stuck, that are underwater, that are losing because they can't refinance. They might be making enough money to just barely hang on, but because of the bank's increased restrictions, they can't refinance, they can't lower their payment, they can't make things better, which is unfortunate because I think we'd have a lot more people able to stay in their houses if we could get to that point. But that's kind of so far down the laundry list of things that the folks in DC want to do, it may or may not ever get to the table this time around.
And it's different around the country, right? Certain communities and cities have more or less.
You look at, and here we are in New Mexico, we're kind of lucky because we have such a preponderance of government industry between the national labs, the Air Force bases, that we tend to have the peaks and valleys in these economic cycles kind of squished a little bit. So where the national average in the home default statistics was up around, 15% or something, we might see 9. And ours will just be compressed. Of course, that also means that our peaks are a little bit less because we just have, there's so much inertia associated with all the government employees we have in the state that they kind of take a lot of the extremes out of the cyclical nature of a localized economy.
When you say default, what exactly do you mean by default?
People who just can't pay their bills, they walk away from their house.
Kind of like Greece potentially defaulting, as we've talked about in the past.
And Greece may, nice segue.
Any more news on that one?
Yes, Greece, countries in Europe are falling in line slowly in terms of this austerity plan, in terms of getting behind Greece, in terms of supporting them. It still doesn't mean Greece won't default. Now, the question is, what happens if Greece does default? Is it the end of the world? No, because we've talked about how much of a participant Greece is in all this. They're less than 2% of the Eurozone's actual GDP and less than 0.5% of the global GDP. So they don't amount to much, even at 2 to 3 times leverage. It's going to be maybe a penny and a half on a dollar. But what'll happen is some judge in some court somewhere will decide what Greece is going to pay all its creditors on all the debt that's outstanding. And everybody that owns $1 of Greek debt might get 20 or 30 cents out of it.
I don't know if I want to be that judge.
You wouldn't want to be, but somebody's got to do it.
Right.
And it's just like a personal bankruptcy. But it's going to be more psychological and emotional than it is actually financial.
Yeah. Well, what about, I heard about the news that came out this week was Apple stock and the loss of Steve Jobs. And back in the past when he announced his retirement, we saw his stock go down a little bit, Apple stock go down a little bit, but that hasn't really happened this week.
Well, and he carries quite a legacy because you know there was a 12-year period where he was off, where he was basically fired from Apple, and they got him back.
That's kind
by
of funny.
buying
They
the
fired him
companies.
and pulled him back in.
They fired him and then bought the company that he had started to compete with him or to go a different direction and pulled him back in.
Crazy.
During that time, the company was really floundering, and when he came back, he turned it around and put it back on the kind of growth model it was on. Now, you know, Mr. Jobs was not back in the lab designing things,
Doing it himself.
casting this, wiring this,
Right,
programming this. You
yeah.
know, he was the visionary. He had the idea, but he also had the team behind him. His, if you call it, you know, a pipeline of ideas, it probably still is 3 to 5 years.
There's a lot of stuff.
There's
he's
a
been
lot of
working
stuff
on.
that he's been working on, a lot of ideas he had that other folks are working on that haven't even started. You know, they're 2 and 3 generations away from the current technology. So I think the shadow he casts over Apple is still going to be in place for several years. And the company still, in terms of, I'm not giving individual stock tips, can't do that, but in terms of technology companies, Apple, in terms of price to sales and price to earnings, is one of the best priced technology companies out there.
Good to know.
So if you're looking at Apple now, it's very expensive. It's
Yeah,
around
it's a lot.
$400 a share. So if you want to try and do a 100 share minimum order, you got to have $40,000 lying around.
Doesn't everybody?
It doesn't everybody, sure.
I wish.
But definitely take a look at Apple, and maybe if you want to do a little digging, find out maybe who they're buying parts from.
Oh,
Might be a
that's
good
an
place to look. We've
interesting
talked about
idea.
that before. Don't just look at one company and get tunnel vision on that. First thing you do is pull up that company's competitors, look at that company's suppliers, and start looking at the other companies that are in the same game if you think that's a good area.
So there's somebody they're buying chips from and plastic for their
They're
cases
buying
and
everything.
all sorts
you
of
know,
stuff.
they're
Screens
plating things.
and-
They're buying screens. They're right.
Yeah.
The power cords, the connectors, all that stuff. They don't manufacture any of that
You
themselves.
don't think about that, though. You just
don't?
think of the individual company. So that's a great tip. Well, before we go, you mentioned a couple of letters I wanted to ask you for some clarification on. You said GDP, and that's gross domestic
Gross domestic product.
What
And
does that mean exactly?
That's the total output of the country. Goods and services all combined.
And any idea what ours is right now?
Ours is, interestingly enough, right about even with our national debt at about $14.5 trillion.
That doesn't sound right. Is that a good thing?
I don't think so.
Yeah, it doesn't seem...
There's a whole school of thought, though, that the way we're going by continuing to print and borrow and spend is the way that you grow economies. And you know, you and I understand from a personal perspective, we can't run our lives like that, and you certainly can't run a business like that and expect to stay in business for very long. But the folks that are advising the president right now and that are in control have bought into this philosophy that that's what governments are supposed to do, is print and borrow and spend money, whether it's real or not. You know, I think the president said the other day, and I don't like to get too political, but he said his jobs bill was paid for. Well, we're still in a deficit spending mode. There's nothing paid for if it's being paid for with borrowed money.
Yeah, I guess we're just going to have to wait and see what happens.
We'll have to see what happens. Now, in terms of perspective, we're at $14.5 trillion. And everybody talks about the rise of China and how strong China is.
I've heard that.
Their GDP is still about a third of ours. So if you think the U.S. is losing, and there are countries that are coming up. We've got emerging markets, but they are so, like Greece, you look at Brazil and India and other countries that are coming into their own. They are so far down the curve, and we are so far ahead that you still have to look at the U.S. economy in terms of how it's influencing the whole world.
So don't worry yet, is what you're saying.
I'm saying don't worry yet.
Good news, good news. Well, we'll see what happens next week. Stick with us next week, guys. Thanks for watching.
See you next time.
And now this week's questions for classroom discussion. Number 1, what is the student loan limit for an entering college freshman? Secondly, how can you avoid overdraft fees? And finally, what does it mean to default on a home loan?